So, what you're telling me is that the music is about to stop, and we're going to be left holding the biggest bag of odorous excrement ever assembled in the history of capitalism.
She came to the door, she said, well, I was on the phone cooking me and my baby some breakfast. And she said, hey, something wrong, it's popping. I said, what? She said, yeah. I said, no. So the girl come downstairs, she come out her apartment with her baby with no shoes on. I said, oh, girl, it's cold outside. She said, something ain't right. I said, oh, man. She said, oh, man, the building is on fire. I said, no, what? I got my 3 kids and we bounced out. We ain't gonna be in no fire, not today.
All right. Today is Monday, March 29th, and this is a market recap for the stock market activities today. You thought that this week will be short and boring, didn't you? Well, think again, because we had a hedge fund blowing up. No biggie, just one hedge fund. This is at least what CNBC and the mainstream media is saying. Just brush it off, total complacency. It's a one-time event, etc., etc. And of course, we're gonna see this lovely face of this degenerate gambler over and over in this video, so I apologize in advance if this image is disturbing to you. And of course, this image is of Mr. Wang of Archegos Capital, which is a quote-unquote family office. And the family office blew up over the weekend due to their degenerate gambling activities and created quite a chaos in the market with them. And we have just started here. Regardless of what the propagandists are saying, that this is a one-time event and it's isolated and the possibility of contagion is very small, yada, yada, yada. We know that this is not the only family office or hedge funds that is deploying this degenerate gambling practice. And it is just the tip of the iceberg of many margin calls to come, and perhaps many financial institutions that will be in harm's way when their clients default on margin calls. I have all the facts for you, plus my epic rant regarding this unregulated jungle of a market that allowed this event to take place. So buckle up your seatbelts, and here we go. The Dow Industrial Average closing in the green by 98.49 points, or a gain of 0.30%. The Nasdaq closing in the red, down 79.08 points, or a decline of 0.60%. The S&P 500 in the red, down 3.45 points, or a decline of 0.09%. And what about the sector's performance for the day? Leading the pack, number 1 and capturing the gold medal, utilities. At number 2 for the silver, consumer defensives, and at number 3 for the bronze, communication services, aka Facebook. Meanwhile, the laggards of the day led by technology, financials, and energy. There is no theme whatsoever in the market today. It is individual winners and losers that dragged each sector to the positions you see on the screen right now. Moving on to the futures market performance. What's going on here? The blockage at the Suez Canal has been resolved, but that is not pushing any inflation expectations or commodity prices down significantly. Today we saw crude oil prices with modest gains, the WTI closing with gains of 1%, Meanwhile, Brent closing with gains of about 0.75%. What's going on with softs? Lumber, one of the main components of the axis of inflation, is closing higher. Meanwhile, we saw losses here led by coffee, cocoa, and sugar futures. OJ and cotton futures closed with muted activities today. What about metals? Declines led by palladium, down big today, about 5% or so. We also saw losses for gold and silver futures. Copper futures with modest declines for the day. Copper is one of the main components of the axis of inflation. Meanwhile, the only futures closing in the green for metals, platinum futures with very modest gains today, barely in the green. And what about meats? Lean hogs taking a break today, and we talked about the lifting of import caps from the Philippines, and that should add some downward pressure in the short term for lean hogs. On the other hand, we saw significant gains for feeder cattle futures with gains exceeding 1.5%. Meanwhile, live cattle with modest gains of about 0.75%. What about grains? Muted activities across the board. The reasoning behind that is the dollar remained steady today. No big movement to the upside or the downside for the US dollar. Moving on to the big casino, the options market, and let's see what's going on here. Muted activities in the casino. The tables were empty today. We are aware that this week is a short trading week, so we're not going to see a spike in the options market volume. However, the absence of the retail trader remains very interesting. We thought that the stimmy money will encourage retail traders to participate more and gamble in the casino. We're not seeing that, and I am arriving at the conclusion that retail traders, specifically the Robin Hoodiots and the likes, got slaughtered, and they are scared to participate in the market again. Just take a look at some of the mania names: Plug Power, Fuel Cell, Blink Charging, Neo, etc. Some of these names are down over 50% from the highs. You bet a lot of people are holding the bag and they are scared of participating once again. So we will see how long would that last. Would a bounce in the stock market encourage retail traders, specifically the speculative side of retail traders, to rejoin the market and participate once again? Or is this all there is for the retail participation in this bubble? Regardless, we had some activities in the casino today, led by Apple with about 830,000 contracts. About 68% of those were calls. Number 2, Palantir with a little over 300,000 contracts. About 72% of those were calls. And at number 3, Neo, with about 300,000 contracts, about 64% of those were calls. So we do have some retail participation, but the absence is very notable. Big difference between the heat of the activities in the options market during August of 2020 and today. How about we take a look at some unusual activities that took place in the options market today, starting with the ticker KTOS. This is a defense contractor that happens to be one of the largest holdings of the upcoming ARK Invest Space ETF from Cathie Wood. And we know that the Cathie Wood cult will stampede and buy anything she sells. So she had an idea of packaging a bunch of stuff, the good, the bad, and the ugly, creating a so-called space ETF, adding to her collection of garbage. And of course, it's just a matter of time before ARK Invest meets the same fate of Archego. But for now, somebody's betting that the party is going to go on. And perhaps the space ETF, when it launches tomorrow, it will be received with positive reaction. In this case, they're making a bullish bet by buying the 30 calls expiration date April 16th, with expectations that the name will climb over 8.5% by then. They paid about $1.10 a piece to enter this trade, bringing the total all the way to $2.7 million. Of course, the way I'm participating in the Cathie Wood mania is via Lockheed Martin stock. I bought the stock a few weeks ago, not in anticipation of the space ETF, but because the stock had good technicals and it will thrive under high inflation. So if Cathie Wood wants to pump my stock, that's just a cherry on top. But it's also scary because it's just a matter of time before ARK Invest starts to collapse and take down a lot of stocks, the good, the bad, the ugly, down with it. We will cover the chart of Lockheed Martin during the technical analysis segment. For now, we're moving on to the ticker SHOP for Shopify. They are making a bearish bet here, betting on more pain to come for Shopify, which also happens to be one of ARK Invest's biggest holdings, by buying the 825 puts expiration date April 16th, with expectations that the name will drop an additional 20% or more by the expiration date, and they paid about $3.50 a piece to enter this trade, which brought the total all the way to $2.8 million. What about the ticker DKNG for DraftKings? They're making a bullish bid here by buying the 65 calls expiration date April 9th. With expectations that the name will climb over 10% by then, they paid about 89 cents a piece to enter this trade, bringing the total all the way to $700,000. I do like this trade, by the way, for DraftKings. What about the ticker ARKK? Speaking of the devil, ARK Invest. They're making a bullish bet here, betting that the space ETF launch will help ARK Invest as a whole. You're going to see all of Cathie Wood ETFs rising higher in solidarity with the new space ETF. We will see if that's going to happen or not, but we have the trader here making this bullish bet by buying the 121 calls expiration date May 21st, with the expectations that the name will climb over 9% by then. They paid about $5 a piece to enter this trade, which brought the total all the way to $2.5 million. What about the trade for the ticker ASML? The name has been riding hot due to the chip shortage, and we know that ASML, AMAT, and Lam Research, these are the infrastructure stocks for chips manufacturing, meaning that if we have a chip war or a chip shortage, these are the bullet stocks, because regardless of who designs, who manufactures, the upcoming flow of chips, that doesn't matter for ASML, AMAT, Lam Research. They will be providing the equipment for the factories and the designers. And therefore, we saw these three names in particular riding very hot. But for now, somebody's calling the top in ASML, and they are buying the 550 puts expiration date April 16th, with expectations that the name will drop over 9.5% by then. They paid about $4.50 a piece to enter this trade, bringing the total all the way to $1.7 million. Moving on to the headlines that shape the day, starting with macro news. Right away in the morning, we received the trade deficit data, and it's not looking good. U.S. trade deficit widened to the largest on record on February to about $86.7 billion versus $84.6 billion in January. And you thought you're going to be tough on China. This country is 100% dependent on China. We have the biggest trade deficit ever in history. We also received some data regarding labor participation. And for all of you old-timers, over 55 years of age, your labor participation dropped significantly from a pre-pandemic reading of over 40%, and now the reading is a little above 38%. So it is a massive drop here for those who are 55 years and older. What about the youngsters? By youngsters, we mean 54 years of age. They're not doing so hot, so. Pre-pandemic reading was 83. We were doing a lot of progress with the labor participation. What do you know? We're now down all the way back to about 81%. Yet the Federal Reserve believes that higher inflation and more liquidity, a tsunami of liquidity, is the key to recovering the labor participation and the employment rate in this country. We will see. So far, spending over $6 trillion. We are still having these readings. When will the Federal Reserve get the message? The unemployment problem will not be solved with more money printed out of thin air thrown all over the economy. That's not going to do it. And all of what that's going to achieve is higher inflation. Speaking of inflation, here's an update regarding the Suez Canal. The blockage, and here it is. Breaking, the ship blocking the Suez Canal is finally free, allowing the waterway to open to other traffic. So that's it, right? We're done with inflation fears. Everything is going to be hunky-dory. All of you inflationary fear-mongers, you should go back to your holes now. Wait, hold your horses, because there is more inflation to come. Of course, the deflationary crowd are putting all their bets on the Federal Reserve trusting the Fed that inflation will be transitory. And even if it is not transitory, the Fed has the quote-unquote tools to deal with it. Ask yourself, are you that stupid? Perhaps, I don't know, but you gotta ask first. Because here it is, Biden to roll out another COVID stimulus relief bill in April, separate from the infrastructure plan, and this is according to his press secretary. And pay attention here, this is separate from the infrastructure bill that will cost about $4 to $5 trillion. Remember, we passed 1.9 trillion and trillions more last year. Now we're about to spend an additional $5 trillion in a quote-unquote infrastructure plan, and they are planning for more cocaine to hit the economy with another stimulus package. And the reason is that this is a zombified economy that is kept alive by the quote-unquote stimulation of more hits of cocaine. Every time the zombie goes back to the dead, they have to hit it with more cocaine, more stimulus, because this economy will not be able to stand on its feet without more stimulation. And the Federal Reserve and the federal government should just come out clean and say that we now believe in MMT, modern monetary theory, meaning that the Federal Reserve will continue to print to oblivion and fund all of these projects, social programs, fight climate change, fight the alien invasion, funding cow milk research, whatever. Doesn't matter. There are no consequences of just printing money to oblivion, right? Wrong. How about inflation? And inflation is not going anywhere, by the way. If anything, it's going to get hotter and hotter and hotter, because here is another reason supporting inflation. Catherine Tai, in her first interview as U.S. Trade Representative, says America isn't ready to lift tariffs on Chinese imports, meaning that we're going to keep the import tariffs not just on China, but even on the European Union. These higher tariffs will continue to contribute to more and more inflation. But bro, the Suez Canal is over. What's with all of this inflation porn and fear mongering? You're too negative. You're just too negative. I don't want to listen to you anymore. You don't have to listen to me. Maybe you should listen to CNN Business. Because here it is. Even before the Suez Canal blockage, global supply chain were being stretched to the limit, making it much more expensive to move goods around the world and causing shortages of everything from exercise bikes to cheese at a time of unprecedented demand. Underline unprecedented demand. Why is that? This is due to the tsunami of liquidity. You think all of this money supply is just going to disappear in a black hole? The economy is just going to take Pepto-Bismol and shit all of that extra money supply, and we're going to have deflation? How stupid are you? This is like saying I'm going to eat 20 cheeseburgers a day and I'm going to lose weight. Go ahead. Good luck to you. More than 80% of global trade by volume is moved by sea, and the disruptions are adding billions of dollars to supply chain costs. Globally, the average cost to ship a 40-foot container shot up from $1,040 last June to $4,570 on March 1st. Can I buy call options on shipping costs? Those costs add up. In February, container shipping costs for seaborne U.S. goods imports totaled $5.2 billion compared to $2 billion during the same month in 2020. So in a single year, the shipping costs more than doubled. But I know there is no inflation, and even if there is inflation, it is transitory. And if it's not transitory, the Federal Reserve has the quote-unquote tools to deal with it. Deny, deny, deny. Put your blindfold on and keep on marching. These expenses could soon mean higher prices for consumers, adding upward pressure to rising inflation. A nightmare scenario for Wall Street, which is already fearful that a spike in prices could force the Federal Reserve to hike interest rates sooner than expected. But the Federal Reserve says they're not thinking about raising interest rates. How many times does Jerome Powell has to stab you in the back before you realize that the Federal Reserve is not in control anymore? At the moment, a lot of these costs are within the supply chains. I think it is inevitable that it will be passed on to the consumer. It is just a matter of time. And this is the take right away. All of these extra costs will find its way to the end customer. Meaning me and you. Just go to the grocery store. I don't know how you people track your budget and your spending, but you know if you are tracking the same grocery bill from a year ago and today, you are paying more. A lot more. I don't know if some of you just put your blindfold on Swipe the credit card and then think later. But just in case you did not get the memo, prices have gotten a lot higher and you are paying a lot more compared to what you were paying last year. Companies feel the strain. Companies from Under Armour and Hasbro to Dollar Tree, Urban Outfitters, Crocs have all warned about the supply chain crunch recently, pointing to container shortages, port congestions, rising shipping costs, and logistics challenges. Costco said earlier this month that it was having trouble stocking imported cheese because of shortage of shipping containers and bottlenecks. An analysis of 7,000 company earnings calls globally in January and February by the S&P Global found that more than a quarter mentioned quote-unquote freight, 37% mentioned logistics, and half discussed supply chains. All of this will be passed to the end customer. Maybe then you'll believe that there is inflation and this misguided policy by the Federal Reserve and the federal government has actual consequences. And one of these consequences is inflation. It's not going to be transitory. Once you create this monster, it's going to float around for a lot longer than you expect. You've already ignited the fire. Now you need the psychology of consumers and corporations to believe that inflation will continue to rise higher, and they have to do the spending now before prices get a lot higher. And there you go. You have a self-fulfilling prophecy, and inflation will not be transitory because the role of psychology is looked over by the deflationary camp and the Federal Reserve. Moving on to sentiment news. What's going on in the stock market mania? You know, we have these inflationary fears and rising interest rates, and the market today is not as easy as it used to last year. Easier markets are followed by harder markets, and market participants should be more disciplined, etc., etc. But are market participants even listening to all of these warning signals? Or are they putting their blindfolds on and stampeding Naruto style, buying the shittiest companies in the world? No profit, no problem. No revenue, no problem. The company doesn't even exist, no problem. Just give us the ticker. These are the Robin Hoodians, of course. They're a bunch of zombies high on meth looking for the next score. They're not investors, they're not traders, they're not even gamblers. Just feed them the ticker over at TikTok, YouTube, Snapchat, doesn't matter, Twitter, specifically if the ticker comes from one of those cult leaders. We're talking about Elon Musk, Kathy Wood, Shamath, Predatoria, Crybaby Davy Barstool, and here it is. They're stampeding to buy unprofitable companies, pushing them higher and higher and higher. When did we see this phenomena last time? You guessed it, right before the pop of the dot-com bubble in the year 2000. History repeats itself, and the donkeys never learn anything. In this market, with rising interest rates, you want to pick companies with the best balance sheets, highly profitable, very low debt, revenue growth, year over year. These are the kind of companies you want to look for and invest in, not the garbage filth that you've been chasing since last year. But I know it's the future, bro. Plug Power, the future, bro. Tesla, the future, bro. NIO, the future, bro. Blink Charging, the future, bro. Even though the company doesn't even have profits. Here's simple math for you. When interest rates rise higher, the present value of future earnings diminish and become less valuable. Therefore, the future bro argument gets flushed down the toilet. Meanwhile, the future value of present earnings becomes more valuable under a regime of rising interest rates. So you want to buy companies, stocks that produce earnings right now, not tomorrow, not the future, bro. What about the tulip mania of the 21st century? It actually exceeded the tulip mania, the original, the old school tulip mania. Take a look at this chart with all of the most insane bubbles in history. Bitcoin in baby blue, and it has surpassed every single bubble in human history. Let me ask you a question. If you are laying a bet right now, how will this movie end? Is Bitcoin is going to go to 1 million, bro? Or is it going to come down crashing just like every past bubble we've seen before? You know, Gary Gensler, he's coming for you. He loves cryptos. He understands them, but that's your worst enemy. You want somebody who's dumb, like the previous SEC chairman who did not know how to order a cheeseburger correctly. You don't want somebody smart leading the SEC because they will regulate Bitcoin and cryptocurrencies. They will become more stable, more attractive to invest in, but the mania will come down crashing, and Bitcoin will stabilize at a lower price. I know, but Reverend Elon Musk, bro, he says buy. He likes Bitcoin. I like Reverend Elon. So I like Bitcoin. I got some news for you, by the way, regarding Reverend Elon in the corporate specific part of this segment. So stick around. What about the exodus from bonds? The long-term treasury drawdowns reached historic levels. Unprecedented levels, the biggest sell-off in history. We haven't even started. You have 40 years worth of accumulation, specifically from foreign countries. What do you think going to happen when these foreign countries start to dump bonds? More in market sentiment. And here it is. Don't blame raising interest rates for the mayhem going on in the mania stocks. And in this case, they're talking about EV stocks. And you have the Robin Hoodites and the likes who were praising Papa Jerome and the Federal Reserve last year for creating the stock market mania, having their backs. Now they realize that the Federal Reserve and Papa Jerome stabbed them in the back. And now they're blaming Papa Jerome and interest rates for the crash in NEO, Xpeng, etc. We're saying don't blame Papa Jerome, blame yourself. You created this mania that is not supported by fundamentals whatsoever. There are going to be consequences. And here it is, the main subject of the day, the blow-up of Archegos Capital, the family hedge funds that defaulted after margin calls. They created the massive tsunami of selling that we saw last week in Viacom, Discovery, and Chinese stocks. Now, this degenerate gambler, Huang, he got caught doing insider trading back in 2012. He's a convicted criminal, and he was a persona non grata in the banking industry, specifically with Goldman Sachs, meaning that in the past, when he sought loans from Goldman Sachs, he was blacklisted and rejected. But somehow, magically this time around, he managed to score massive loans and margins from Goldman Sachs. So what happened here? What changed? The answer is that tsunami of liquidity from the Federal Reserve. The funny money being printed out of thin air and thrown all over the place. That is landing on the lap of banks, by the way, not regular folks. One of those banks is Goldman Sachs. Now, remember, all of these banks are regulated and they have certain ratios that have to be maintained. These are the Dodd-Frank reforms, regulations from the last financial crisis. So for a bank like Goldman Sachs, when the tsunami of liquidity gets ushered and now they're drowning with cash, they have no choice but to start lending that cash to maintain all of the ratios they have to maintain under the regulations. Goldman Sachs was well aware that Mr. Huang is a clown, a degenerate gambler, a scum of the earth, a cheat, a thief, all of that. But they gave him loans anyways because of the abundance of liquidity. That is the main source of this mania and this problem in the market, the abundance of liquidity. And I can tell you, from my own experience, I am being offered millions of dollars, millions in margin. And it is getting very tempting because you are aware that I shorted Viacom when it was trading above 100. Now, had I went all in with margin, I would have become a billionaire already. You might have heard my name in the news. In CNBC, YouTuber and short seller, known as the Maverick of Wall Street, made millions of dollars. But unfortunately, that didn't happen. You know why? Because I am disciplined. And in my entire career, I've never used margin. Never. But the margin mania is all over the place. Remember this kid from TikTok who did an experiment borrowing money on margin from Robinhood to gamble on Tesla options for a day trade. And he was offered tens of thousands of dollars. We have people gambling with margin on options, not stocks. Options. This mania is out of control. But once again, you have all of these financial institutions with a lot of cash. They don't know what to do with. So if you need margin, if you need cash, we got a lot of chips. Go ahead, grab some, put your blindfold on, and sit at the blackjack table and give it a shot. And in the case of Archegos Capital, they were engaged in a very high-risk practice. It is called total return swap. You don't need to know the details of this practice, but just understand it involves derivatives. And it is extremely risky, not just for the hedge fund, but for the other party on the other end of the trade, the banks. the lending institution. And here is the other point to make. Archegos Capital never disclosed any of their positions with filings with the SEC. Why is that? Because it is quote-unquote family office, not an actual hedge fund. So they are immune from all of the regulations that impact regular hedge funds. Now, given these loopholes, Mr. Huang and Archegos Capital managed to score a lot of margin and they started gambling in the casino. The most reckless, irresponsible gambling ever. And they've decided to channel their inner Robin Hoodian, their inner Wall Street bets kind of morons, and they looked for the heavily shorted stocks from Chinese stocks, the likes of GSX, which is a fraud by the way, and it was exposed by the likes of Muddy Waters, led by Carsten Block, who exposed that this company, which is a remote education company, a Chinese company, he exposed that the students are actually bots. There are no students. The company is a fraud, but the Robin Hoodians put their blindfolds on, believing that the short seller is the bad guy here, and we will show these shorties. We're gonna stampede and create a short squeeze. Well, it wasn't just the Robin Hoodians. We now know for certain the hedge funds and family offices were involved in that practice, specifically Archegos Capital. And isn't it a coincidence that at least 3 former Tiger Asia executives coordinating together to buy the same stocks that are heavily shorted, the likes of GSX, to create a short squeeze? Is that a coincidence or what? These people should be in jail. This was a coordination to trigger a short squeeze. There was no fundamental case whatsoever in buying GSX and other names, but they did it for the sole purpose to trigger a short squeeze, and they did it via borrowed money. And the real tragedy is that when they are successful in triggering a short squeeze, and you see a stock like GSX, Viacom, Discovery, and many other stocks shooting impulsively higher, some of the retail crowd will get seduced by the movement, and they will believe that it is legitimate and it is due to momentum, and they chase the moves in these names. And now they find themselves as victims for games played between hedge funds. We talked about this before in this program. When the whole GameStop short squeeze started and the morons over at the mainstream media were running with the narrative of David versus Goliath, this channel exposed everything ahead of time. It took me 1 day to figure everything out, and I told you that this is a civil war between hedge funds, and Wall Street bets and the retail participation is just the sideshow, the distraction. But there is a massive game being played behind the scenes between hedge funds. Now, let's talk about what happened here with Archegos Capital. How did the whole thing blow up last week? Here is my theory. It started with Chinese stocks crashing. And that started to happen a few weeks ago, by the way. The moment we heard that the SEC is planning to delist certain Chinese companies. Right away, you saw certain Chinese names selling off severely. That was the first warning signal that Archegos is in trouble. Who has access to that kind of information, by the way? Their biggest lenders, the likes of Goldman Sachs, and if you've worked in capital management or any investment bank, you know these banks have warning triggers, and when a client is about to be defaulted and get a margin call, they know that ahead of time. So now Goldman Sachs is aware that Archegos is in trouble. What are the 2 biggest holdings for Archegos? Viacom and Discovery. Goldman Sachs is well aware that this degenerate gambler is all in on Viacom stock. So you think it's a coincidence that a couple of weeks ago, Goldman Sachs, in coordination with the Redstone family of CBS, decided to issue more shares and raise billions and billions of dollars at the price of 85? You can call me a conspiracy theorist all you want, but are you that naive? Because when Goldman started the offering that pushed the stock price of Viacom downward, now bear in mind that a lot of Chinese stocks were getting hammered ahead of time, so dropping Viacom was the nail in the coffin for Archegos. Goldman Sachs knew that ahead of time. And once Viacom stock started to flush downward, losing 10% a day, Goldman Sachs decided to trigger a margin call. Now, this is the Hunger Games between banks. Goldman Sachs triggering the margin call that in itself caused the collapse of Viacom and Discovery stocks. And right away, Archegos is in trouble. But the good news for Goldman Sachs is that they get away unscathed because by triggering the margin call, they get to sell Mr. Huang's holdings and cover for their asses. Who doesn't get to cover? Other lenders. And today you saw the likes of Credit Suisse, Nomura, and perhaps there are others. This story is not finished yet. We don't know who the other lenders are because we know Goldman Sachs and Morgan Stanley already got their VIG. They triggered the margin calls and they already got paid. They liquidated Archegos Capital holdings and they covered for what they owed. But for Credit Suisse and others, it's a different story. And they're already saying prepare for a lot of pain because they will not get paid what they're owed by Archegos. Because Goldman was the first to trigger the margin call, they got paid first, and now Archegos doesn't have any more money to pay other lenders. So once again, I ask you the question, do you think this is a one-time thing and we are out of the wood? Or is there more to the story? Are there other banks and financial institutions that are about to suffer in addition to Nomura and Credit Suisse? And the other point is, if this practice was done by one family fund, quote-unquote family fund, how many other funds were doing the same practice and going insane on margin, all in, gambling? That raises the question, who is next? Who is the next hedge funds that will blow up? And right away you're seeing the contagious effect in the market today. The main names suffered the most losses. And the reason is you have all of these hedge funds getting nervous and they're saying we better book profits or even losses. Doesn't matter. We don't want to get margin called and default like Archegos did. So once again, I'm not buying this bullshit narrative I heard from CNBC and the likes today that this is a one-time event, it is isolated, and we don't have to worry about another hedge fund blowing up. Moving on to corporate-specific news, starting with the flying coffin, Boeing. You know, the flying coffin is getting out of the woods now. We're hearing more and more good news. Boeing delivered its first 787 Dreamliner since October, while mechanics continue to inspect other planes for small structural defects. You know, defects like the engine blowing up. No biggie. We are flying cats. They have other lives, you know. If they die, they can come back again. And here is the flying coffin itself. Boeing wins its biggest 737 MAX order since safety ban left from Southwest. So Southwest is ordering more flying coffins, and that lifted shares of Boeing to rally significantly today. What about AMC? AMC Entertainment stock has rocketed, and 4 executives recently sold a total of $3 million of shares of the theater chain. No executives sold last year. Of course, they are milking the mania, and who knows what other hedge fund is responsible for pushing this thing higher. What about Vizio? You know, the new IPO. Vizio went public on Thursday as one of the biggest manufacturers of television sets in North America. But the company is looking to a future in the streaming ads that appear on those sets too. Here is a confession from me. I like the stock. Moving on to the evil empire of Amazon. Amazon is getting sued for failing to give warehouse workers meal and rest breaks. This is the 21st century slavery, the corporate slavery. Meanwhile, Mr. Bezos is the richest man in the world, and he gets to dump billions of dollars worth of shares every quarter or so, and who cares? But I know the defenders of capitalism, and this is not capitalism, by the way, this is gangsterism, but you are in an illusion. You know, you've been drinking the Kool-Aid for too long, you cannot distinguish the difference. And you keep telling me that Amazon is successful, Jeff Bezos is smart, he's rich because he's smart. Baloney. Amazon would have never been possible without the Federal Reserve. Think about it. Here is a company that wasn't profitable for years, decades. No profits whatsoever, but the stock continued to rise higher and higher and higher due to the endless QE and easy money from the Federal Reserve and the loopholes in taxation policies, meaning that Amazon continued to grow and grow and grow because of their equity value. They were able to secure loans, using these loans to undercut the competition, destroy mom-and-pop businesses, and after years and years of that practice, they finally managed to become profitable. And even when they are profitable, they don't pay any taxes because all of these losses from past years, they get deducted and Amazon ends up paying nothing in taxes. So keep telling me, oh, Jeff Bezos is just smart and you're jealous. No. Amazon was never possible, would have never happened. It would have been a failing business right now as we speak, absent of the Federal Reserve policy and the taxation loopholes. Moving on to, you guessed it, the souffle, Tesla. How could we do a corporate-specific news segment without talking about the souffle and their evil practices led by Reverend Elon Musk? Tesla double-charged some customers for new cars, leaving them desperate for refund details. The culties are begging Elon on Twitter, "Why did you charge me twice?" Of course, we know why Elon charged you twice, so he can write it on his financial statements that he sold 2 cars when he actually sold 1. But it is always fun when the cult leader stabs his culties in the back. Moving on to Ford. What's going on here? Ford and HP team up to make F-250 parts from 3D printer waste. Oh, how lovely. They're gonna print a new pickup truck out of waste. Does it happen to be human waste? I thought the Dodge Ram is the shitty pickup. Moving on to NIO. Chinese EV maker NIO will halt production at one of its factories for 5 days because of semiconductor shortage. And by the way, it's not just NIO. This is a contagious impact. Dodge Jeep maker Stellantis to halt some auto part productions due to chip shortage. And here we have Hyundai Motor to suspend production in South Korea due to the chip shortage. Just a friendly note to all the Robin Hoodiots who are listening, don't go on and stampede and buy chips, tortilla chips from the grocery store because you think that this is the future, bro. All of that chip shortage. We're talking about semiconductor chips. We're not talking about tortilla chips. Although when it comes to tortilla chips, you want to buy the dip. But when it comes to chip stocks, you don't want to buy the dip, at least not right now. And with all of this shortage, perhaps we're not going to have cars. Perhaps we're going to start using our bikes and, exercise, burn some calories. Whoops, wait for it. Porsche is now making electric bicycles. They are not cheap. What is an electric bicycle, by the way? Is it going to pedal itself? You just sit your ass over there in the seat, press the button, and it pedals itself? How fat are we planning to get? We know that the average millennial gained over 40 pounds during the pandemic. But perhaps 40 is not enough. Let's make it 50. To the moon, bro. And here's the last bit of corporate news for all of you dorks out there. VW accidentally, quote-unquote accidentally, leaks new name for its US operations. Volkswagen. Ha ha ha. Moving on to the heat map analysis. Let's see what happened today. Do we have any theme? Can we extract any valuable information looking at the heat map? I would argue not, because we did not see the inflationary trade outperforming or the deflationary trade outperforming. We saw the market treating names individually. Meaning, let's start with financials, for example. There is this legitimate fear of who's next, what's going on underneath the market. Is there another hedge fund that's going to blow up? And what are the ramifications of that on financial institutions? So we saw a mini sell-off in the financial sector. But again, the bulk of the pain happened to be in the names involved with Archegos. For example, Credit Suisse down about 11.5% today alone. What about Nomura? Down 14%. And we saw Morgan Stanley down over 2.5%. Goldman Sachs, of course, the degenerates that they are, managed to escape the bulk of the pain by triggering the margin call. Goldman Sachs was only down 0.5%. And by the way, I own the stock. So I am talking badly about Goldman Sachs, but that doesn't mean that I'm not going to invest in it, because once again, crime pays. I'm not here to solve the world's problems. I'm here to make money. But the take is, for names like JP Morgan, Goldman Sachs, Bank of America, the dips are to be bought, but let the process work its way. Let the dust settle. For example, I got emails today, people asking, should I buy Viacom? Should I buy the dip in Discovery? Hold your horses. Let the dust settle. And then there is a time and a place to buy the dip. But again, in financials, I'm not worried about JP Morgan, Bank of America, Goldman Sachs, even Morgan Stanley. I'm worried about names like Credit Suisse and Deutsche Bank, who were already under trouble before the blow-up of Archegos. What about healthcare? Once again, the healthcare sector is underappreciated, and we have a lot of value names, specifically in the big drug manufacturers. and today they managed to outperform. What is not outperforming is biotech. Biotech doesn't perform well under a regime of rising rates. We saw a lot of pain specifically for Moderna. Moderna down over 7% today. What about industrials? Mixed picture. Across the board, we don't have a specific theme here where sectors are rallying all together. We have individual names within sectors rallying or punished, but the rest of the sector is muted. For example, in industrials, we talked about the flying coffin Boeing. Boeing closing the action today with gains exceeding 2%. Likewise, Lockheed Martin closing the day with gains over 2% due to the optimism of tomorrow's launch of Cathy Wood Space ETF. What about materials? Mixed picture, but we saw pain for copper, specifically Freeport, down over 2.5%. Meanwhile, gold names are outperforming. Consumer defensives remain the best place to park your money for now, whether we're talking about PepsiCo, Coca-Cola, Kellogg, Mondelez. These names are weathering the storm and the volatility perfectly. Unlike, say, the reopening trade, whether we're talking about airlines, casinos, hotels, cruises, all underperforming today, we have a lot of concerns about the rising case numbers of COVID-19 cases, and therefore we're seeing profit taking in the so-called reopening trade. Likewise, we saw rates rising higher for treasury yields. While that did not help the financial sector due to the concerns of the hedge fund blowing up, it did have an impact in the market. We saw an underperformance from home builders, the likes of D.R. Horton, down over 2%, Lennar down over 3%, Toll Brothers down about 4% today, even a name like Zillow down about 6% today. We have other mania names like DoorDash, Snapchat, Zoom, all suffering severe losses today. In the technology sector, what's outperforming is Facebook, Google, the big technology names holding steady. What's not holding steady is the mania overvalued names. The likes of the software names, Palantir was down another 4% or so today. Square down another 3%. I am short the name via options. Names like Snowflake, DocuSign, even the semiconductor names got hit today. With exception of Nvidia, Nvidia managed to close in the green. So once again, we don't have any particular theme today. All of what we witnessed today is the market treating names individually. Moving on to the charts analysis. What do we see here? Starting with the 15 minutes chart of the SPY, S&P 500. Nothing to see here. We are trading almost at all-time highs, and the sky is the limit. However, we have to watch out for the performance of financials, industrials, energy, even technology. Because if technology alone is underperforming, but we see banks, energy, materials, industrials outperforming, the SPY will do just fine. But if we have the reinflationary sector of the market joining the underperformance with technology, then you'll start to see the SPY flushing down. What about the daily chart for the continuous contract? Perhaps we can see more valuable information here. We are flirting with the very important resistance level of 3,960. We still don't have a decisive crossing above 3,960. We are waiting and waiting and waiting for that to happen. Remember, we have a slight negative divergence in the RSI, and that is a little concerning. What you don't want to see here, if you are bullish on the S&P 500, is a reversal, another rejection from 3,960. Because we tried the support of 3,862 to crack above 3,960. That did not work out, so the chart went a little lower. It went to the support of the yellow trend line, and it bounced higher. It managed to close above 3,960, but it is struggling yet again. And the bounce effect that supported the move off the yellow trend line is going to start to fade out. So you better start cracking above 3,960 as soon as possible, because a reversal and another rejection from that particular level will mean that the SPY will have to go lower in search of support to gather enough energy to crack above 3,960. And the lower you go, you risk breaking the bullish trend. What about the Qs? 15 minutes perspective. We talked about 313 as the center of gravity. You crack below 313, the center of gravity will pull you upward. You go above 313 and it pulls you downward. Today, we went above 313, and we revisited the support of 313, retested it over and over and over again, and we managed to close above 313. The challenge for the Qs is to continue to build on that momentum all the way until the Qs recaptures 323 and lock that support. Absent of doing that, 313 will continue to pull the chart downward because 313, as you might know already, is very possessive. By the way, you have to build the momentum and recapture 323 without gapping. No gapping. Gapping will trigger the gravity of 313 to become even stronger. You gotta do the crossing and recapturing the support for 323 during the trading hours. What about the daily picture for the continuous contract of the Nasdaq? So long as we are closing above 12,766, then the reverse head and shoulder formation remains a possibility to trigger another attempt to crack above the purple trend line, and specifically the resistance level of 13,599. Cracking below 12,766 will be my line in the sand to short the Qs, so I am watching that level very closely. What about the IWM small caps? Here is the chart with the same markings you saw during the last video. And what do we see here? Here is the update. We talked about the series of higher lows, and it is not a reversal yet. It is just an aftershock reaction after a massive drop. Today, at least from a 15 minutes perspective, we are seeing a double top formation followed by a bear flag. And that should pull the IWM chart lower. Now remember, we have a lot of hedge funds and family offices getting extremely nervous after the blow up of Archegos. So they are starting to dump their highly levered positions, the risky positions, which happen to be small cap mania names. What about the daily perspective for the RUT, the Russell 2000? Once again, if you want a confirmation to start shorting the Russell, you want to see a breakage of the trend of higher highs and higher lows. So far, we have not broken the trend. We have a negative divergence in the RSI, and we have a noticeable weakness. So for a guy like me, I've seen enough, and I already have puts on the IWM. But if you want to be 100% certain, wait for the breakage of the trend. Wait for a lower low or a lower high, preferably both. What about the dollar index? Spiking a little higher today. We have the resistance line. We're getting very close here. The Dixie has the energy and the momentum to continue to rally higher. And the reason is we have a lot of nervousness in the market, not just in the US, but globally. And we have a rush to raise US dollars due to the uncertainty, and that is helping the dollar index to trade higher. What is the impact of the dollar index rising higher on gold? Gold doesn't like it. Gold wants a lower dollar, and it's been waiting and waiting and waiting below the Fibonacci retracement level of around 1750, waiting for the dollar index to start reversing. But the dollar index hasn't reversed yet, and therefore gold is saying, all right, I'm done with this. I'm going to start going lower. If this son of a bitch doesn't go down, then I'm going to go down. And therefore, I'm saying buying gold here will come with a lot of stress because you're dealing with double headwinds, double whammy. On one hand, the rise of the US dollar. On the other hand, the rise of treasury yields. Gold likes neither. And today we saw both the dollar index and yields rallying higher. What about the so-called digital gold? Bitcoin, what's going on here? We had the bear flag and that played to the downside. But now the chart is recovering and putting a short-term reversal. I am watching the MACD indicator for a potential crossing, creating positive impressions on the histogram. Likewise, we have the negative divergence on the RSI that I am watching for crossing and reversing the negative divergence. Doing so will be an indicator that they raise another leg higher for Bitcoin. And I gave you my number, 68,000. Whether that's going to happen or not, who knows? But for now, the trend is still intact in Bitcoin. And we are watching for a potential for an explosive move higher because Bitcoin held strong, weathering the storm of the market's volatility and the hedge fund blowing up, and lots of other events. Bitcoin managed to hold steady. That will embolden the bulls and those waiting in the sidelines to buy Bitcoin. That perhaps you're not going to get a better deal than this for now. So those who've been waiting for a better entry price for Bitcoin perhaps can experience FOMO and start buying Bitcoin at these levels. What about the 10-year treasury yield? This is a 3 hours chart, and the trend remains intact. higher highs and higher lows. Absent of breaking the trend, then the trajectory for Treasury yields remains higher. Moving on to the TLT, Treasury bond prices. We have a solid rejection here from the Fibonacci level of about 137. This is not good because we talked about 139 as a potential reversal. We did indeed reverse very close to that level. And as you know, I am eyeing the level of 134.5. Closing below that level will embolden me to buy the dip in financials, specifically the good ones, JP Morgan, Bank of America, etc. Because closing below 134.5 will mean that yields will surge higher, perhaps going as close as 2%. And that will indeed embolden the inflationary trade, specifically financials. Moving on to the VIX, what do we see here? The VIX above 20 once again. And of course, I called myself a donkey yesterday for closing my VIX positions, but once again, I can re-enter these positions easily. But I'm looking for two things here. Number one, a positive crossing in the MACD of the VIX. There is a potential for a positive crossing. Number two, I'm looking for the S&P 500 futures to get rejected from 3,960. If these two conditions are met, then you bet that I will be opening VIX positions once again. What about Apple, the big kahuna? What's going on here? Apple outperforming the Nasdaq today. And remember, as Apple goes, so will the Nasdaq. Apple closing above 120, and we have a bull flag formation that is supposed to take us higher. The problem for Apple is you got to recapture 125 and lock that support, and you have to do it during the trading hours. No gapping. We don't want to see any gapping overnight, because the center of gravity remains 120. So long as you're trading above 120, it will act as a force to pull the chart downward. To erase that gravity, you got to recapture the support line of 125. We know that this is a shortened trading week, but we have a lot of portfolio rebalancing going on. Apple happens to be the most widely held positions within pension funds, so they are buying bonds and dumping some stocks. The assumption here is that these pension funds will have to liquidate certain stocks positions. They are invested in ETFs. When they dump the Qs, for example, Apple will suffer as a result. We don't know what they're planning to do. So what we have to look for is 120. Breaking below 120 will be a shorting signal because the next solid support is 113. We have a minor support line at 117, but if you cross and close below 120, 117 will likely not hold. So we'll have to look for 113 for the next support. And what about Tesla, the souffle? What's going on here? Not looking good. We are now at the lowest Fibonacci retracement level, and I told you for me to reverse my stance on Tesla, it has to close above 679 from a weekly perspective. That is looking less likely by the day. I am already holding Tesla puts. I told you that we have a gap between the green and red hammers. If that gap is closed and Tesla doesn't bounce, that would be the shorting signal for me. And indeed, I did buy puts. When do I double down? Closing the week below 625. That would be another signal to double down on the puts. Who knows which hedge fund will blow up next? And perhaps the liquidation process this time around will involve Tesla. And therefore, every holder of these mania names, high valuation names, are nervous right now. Because what if Tesla is the next Viacom? What if NIO is the next Viacom? Etc. etc. Moving on to the last chart of the day of LMT, Lockheed Martin. We know the space ETF is coming out tomorrow. That perhaps will lift LMT prices higher. I did buy the name a few weeks ago once the name managed to close above the level of 339. We have a descending line, a downward trend since the pre-pandemic highs. We have now broken that trend. In addition, we have a positive crossing in the MACD. So we have a lot of momentum here behind Lockheed Martin to push the chart higher. Perhaps the space ETF optimism will add more fuel to the fire to shoot Lockheed Martin higher. The problem is, if the market does not receive the space ETF with open arms, and we see the space ETF trading negatively on the first day, then Lockheed Martin will get punished along with the rest of the names in that particular ETF. This is the risk that you have to carry holding this name. That now Cathie Wood polluted Lockheed Martin. Initially, her involvement could push the name higher. and I wouldn't mind that at all. But we know that Cathie Wood has been acting irrationally as of late, and if her fund is the next to blow up, then the space ETF will also get punished. Perhaps this is at a later time, not right now. So I am keeping my eyes open with LMT to take profits if we see big pops. But the chart, the technicals, for now look very positive. Moving on to the conclusion of this video. What do we have on the economic calendar for the remainder of the week? We do have the Consumer Confidence Index that would be very important to watch. We have more Fed personalities spewing propaganda. On Thursday, we have the per usual weekly jobless claims. We have the very important ISM Manufacturing Index in addition to the manufacturing PMI. And on Friday, we'll be off. No trading, but that doesn't mean that we're not going to receive more macro data, specifically the big jobs report. Before I log off, let me say thank you for all of the subscribers and the audience of this program. Whether you agree or disagree with me, one cannot ask for a better audience. This is still a small channel. We're not pumping stocks. We're not involved in the mania, but we have a great audience, a diverse audience, and I appreciate every single one of you. With that being said, that's all I got for you today. And I'll talk to you again tomorrow. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.